markets are trading firm. 18,700 is back and 44,000 on the bank Nifty. Well, last evening, the US CPI, Indian CPI, that also both the readings have come in lower than what the street is estimating and also is powering the rally. Vinay Jaising is here to talk more about markets and investing. Vinay, afternoon. Thank you so much for your time. So, before we talk to you about your strategy and stocks, etc., Vinay, I want to understand how much role are improved or favorable macros making for Indian markets in the current buoyant environment?
So it's interesting we say that. India has underperformed the market this year by almost 9 to 10%. Nasdaq is up 28, 29%. India is just out at 0% levels. Indian economy is doing a lot more better on the macro front. Our interest rates between our 10-year chart and 2-year chart is both below 7% and in a positive zone. US on the other side is negative, and US's GDP is growing at probably 1/5 what India is growing at, but Nasdaq is doing better. So I think what is happening is there is cheap or free money or hot money following the AI related stocks or Nasdaq, or look at Nvidia, look at the other stocks in Nasdaq, which are up by more than 150%, leading to, almost 29-30% upside there. So the time for India has come now that the macros are doing better. FIIs are looking back into the country. And so far, we've not seen the movement as much as we should, as we've seen in the rest of the world.
Vinay, the strategy which you manage and operate on, how is the earning visibility of your strategy, especially with the quarter just gone by? Talk to us about what kind of blended earning visibility does it show 12, 14 months far out, and also a sense of what kind of commentary did you gather from major holdings managements this quarter?
Thanks again, Ajay. So I think the earnings trajectory for the companies we cover are growing between 14 to 15% per annum. It's only inching up post the last quarter's numbers. If you look at last year, fiscal year 23, the overall earnings for India Inc. for about 500 companies which have come out, the overall numbers are up by about 10%, but largely driven by banks which have grown by 45-50%. You take the banking sector out or the financial sector out, the overall earnings for the country are down. And having said that, if I were to look at QOQ basis, the earnings of non-banking sectors up by 35-40%, with revenue growth of 11-12%, margins improvement. So it's all showcasing to you, A, commodity pricing is falling, which leads to better raw material margins, and B, volume growth is being weighted for the next quarter to come up. And I think that's what you'll see in the next 12 months to 24 months. Banking sector, which has been, I think, one of the biggest contributors to index earnings, almost 40%. That'll slow down, that'll go down to half. The 40% growth will go to 20. But the other engines will start propelling pretty much. Look at CapEx, look at industrials. Maybe the pharmaceutical and the chemical space would have one more quarter of pain. But post that, even they'll start contributing. So I think the next 2 years will all be about non-banking sector driving the growth of the profit share of the overall index.
What is your hypothesis, Vinay, regarding the rates trajectory? Even if we take conservatively 6 to 8 months far out, if rates indeed start edging lower and the rate cut cycle actually starts, say next year or early next year, what kind of impact would it have on the listed universe or equity as an asset class?
So time to smile again. I think when interest rates move down, the cost of capital goes down and PEs start moving up. And that's the time for Indian equities to look a lot more resilient than what they have currently. Currently, we've been avoiding the highly levered companies. Overall, India Inc.'s leverage too is low. One thing lacking in India, or which lacked in India, let's say a year or ago, was the overall capex cycle, which hadn't worked. And I think that is inching up from 4.1% of overall GDP last year to 4.9. Bottom-up analysis, which our team suggests to us, suggests about 60 to 70% growth in the overall order book. And order book to revenue has grown from 2.5 to about 4 times. So I think you're seeing interest rates move down, which will lead to more capex growth in the sector and a lot more limelight for earnings visibilities and sectors like capex and industrials.
I understand you are positive on capex and industrial, specialty chemical, etc. But at the same time, we all know that it has been, quarter after quarter of good performance from these spaces. And the stock performance also has come. So they are no longer as cheap as they were, say, 12 months back. Which are the areas where you would be keen to deploy incremental capital which is coming towards your fund?
So, if you look at again the capex sector and industrial sector, at one time there were stocks which we were buying which were 40, 50 times P, which have moved to 70, 80 times P. But currently you have stocks like Kirloskar Oil, which is at 9, 10 times 1 year forward P, stocks like Wabag, which are again at 9, 10 times 1 year forward P. So you have to hunt a little bit more, do a little bit more of groundwork, and the same sectors will give you winners of the future. Mind you, the important point out here is the quality of balance sheet for these companies are a lot more better. Most of them are net cash, and the ROCE is increasing, and the earnings visibility is 20 to 25%.
You have made a very good example in those stocks. What about chemicals? Which are the beaten down chemicals where you're finding comfort now? Because we pick up that the raw material scenario and freight costs are easing back, and the visibility is back for this sector almost 4 years, after 4 years. What are the names you would be studying?
So though we had a positive alpha for the last year, a sector which hurt us was the specialty chemical sector, where we were a lot more overweight. The inventory levels in China are still a quarter or two, based on what our analysts suggest to us. It's waiting to come down. So you can see a lot more pain in the next quarter, and then it moves down. Having said that, there are two stocks which we really like. One is Tatva Chintan, and the other is Ami Organic. If I had to say a third stock's name, that would be Archean Chemicals. These stocks all have different stories. If I talk about Tatva, they're playing primarily the SDA chain, wherein you're betting on CVs of China taking off. In the future, you're betting on electrolysis and flame retardants as well. In the case of Archean, you're betting on the bromine chain and the salt chain. Archean is trading at 10 times 1 year forward earnings with a 39% ROIC. So valuations too are going away. So we are betting on these 2-3 names in the specialty chemical space.
Lastly, I'd also like to know about your defense positioning right now. Same challenge. Many of these names are no longer inexpensive.
So the good news is the order book is also no longer as low as it was earlier. So if you look at Hindustan Aeronautics, its order book is as much as 8 times its revenues. If you look at Bharat Dynamics, its order book is as much as 6 times its current year's earnings, which means visibility is very, very, very high. If you look at Bharat Dynamics, you're talking about 7 to 8% of exports this year. In the next 2 years, going to 14 to 15%. In the next 4 to 5 years, going to 25%. You're looking at them at 20, 21 times F25 PE, and with ROCEs of 20%. So very similar stories for both biggies, which is Hindustan Aeronautics and Bharat Dynamics. Bharat Dynamics is a mid-cap name. It's yet being discovered. So we are betting our eggs on the defense sector even today.
All right, Vinay, great chatting always. Thanks so much for your time. That
Thank
was
you.
Vinay Jaising of JM Financial's Portfolio Management Services.